This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Dr. Thorsten Polleit joining us from Frankfurt this morning. Dr. Polleit is a very well-recognized writer and noted Austrian economist. He is chief economist of Degussa Gold Trade, president of the Ludwig von Mises Institute of Germany, partner at Polleit Riechert Investment, and if he has any extra time on his hands, he's an honorary professor at the Frankfurt School of Finance and Management. Welcome, Thorsten.
Hi, Gordon.
Did I get that right? Here. Are you in Frankfurt this morning? I just thought about that.
Yeah, it's pretty close to Frankfurt. That's absolutely okay with me.
Okay, because sometimes I'm talking to you in Zurich, sometimes you're in London, etc. Yeah. Thorsten, I'm so glad to get you back on. There's so many things that have happened since we last talked, but you wrote a paper on the issues with negative interest rates and to try and explain and understand it. You published it with the von Mises, but I'd like to use it as a platform and what you concluded in your thesis in that paper to springboard into what's happening with this $5 trillion negative nominal rates of bonds, sovereign bonds that are trading right now, and what appears to be a war on cash that's emerging too, and are they linked? So, could we? Your paper was called the natural interest rate is always positive and cannot be negative. That was the title of it. Can you explain it to our listeners?
Yeah, thanks very much for the opportunity, Gordon. As I said, it's always a pleasure talking to you about important issues for savers and investors alike. See, when you talk about interest rates, it makes sense to distinguish between market interest rates and the so-called natural rate of interest. The market interest rate is an observable phenomena. Like, for instance, in the credit market, the demand and supply of credit generate a market interest rate, like the interest rate on bonds or the interest on loans or the interest rates on deposits. And then we have the so-called natural interest rate. The natural interest rate is an element of the market interest rate. See, the market interest rate consists of this so-called natural interest rate plus an inflation premium plus a credit default premium plus a liquidity premium. And the important issue in my paper is really this so-called natural rate of interest. So we should ask ourselves, what is this natural rate of interest all about? Now, the natural interest rate is a direct consequence of human action. We as human beings act purposefully. We need means to achieve certain ends. Action requires time. There is no timeless action. Time is scarce, so we have to economize time. Yeah. The natural interest rate is a direct consequence of the insight that we human beings are acting beings. And for instance, we as humans have a positive time preference. That means we as humans value present goods, so goods that are available today, more highly than goods that are available at some point in time in the future. Exactly. For instance, an apple today is more valuable than an apple in 100 years' time. Or $1 is more valuable today than $1 to be paid out in 1 year's time. And the price differential between the present good today and the good available in the future is the so-called natural rate of interest. It is within ourselves we as human beings value present goods more highly than future goods. And that is a logical consequence of the insight that human beings act. And this natural rate of interest can never be zero. If the natural interest rate would be zero, it would mean that you would value two apples available in 2,000 years more highly than an apple available today. It's a logical impossibility that the natural rate of interest can go down to zero. And we couldn't, as human beings, not even conceive of a natural interest rate which is in negative territory. It's a logical impossibility.
So what does that mean in the current environment that we see ourselves in, where we see this $5 trillion of nominal bonds, sovereign trading negatively? That's not the natural rate, obviously. That is a mispricing that's going on.
Absolutely. And the starting point is we have to understand that we live in a fiat money world, or you could say it's unbacked paper money, the US dollar, the euro, and the producers are the state-owned central banks. They are the monopoly producers of this so-called fiat money. And this fiat money is basically produced through credit expansion. And so central banks have a very strong grip, or they can actually control interest rates in the markets. And so we have to say that we live in a world where we have hampered markets, where central banks, for political reasons, are in a position to determine the interest rate. And what they do is they push the interest rates towards zero, and in some cases, like for instance in the euro area, into even negative territory. And of course, it's a mispricing. It goes against the insight that the natural rate of interest can never be zero. It's a forceful, a coercive manipulation of credit markets.
Is there possibility that there's even more going on here? And I say that because this is smart money. I mean, they have a lot of restrictions on them, but $5 trillion buying sovereign bonds, where they're willing to pay, I'll call it a penalty, to have money held by somebody else. That is, and with some assurance they're going to get it back. That is sovereign money, at maybe even a less rate, but they'll get it back and they're paying a penalty. And is it because there's so much, two things, so much cash out there? It's not a savings glut. There's just too much credit available looking for a safe place to hide, if you would. And secondly, in the bank's case, they need repos to use as collateral to generate rates, and therefore they're willing to get those treasuries at even negative rates, because then they get the repos, which they rehypothecate. That is, they leverage those up at a significant fashion. So the penalty they're paying is small in comparison to their loan. Is that a possibility to what's going on here?
Maybe there are various factors at work. What you say is possibly one strong explanatory factor. Another factor is clearly that we have a lot of so-called institutional investors who are basically forced by regulation to buy into long-term bonds at whatever price. They have to come up with a certain asset liability management. And in situations like this, they struggle for a yield pickup, and they buy virtually any kind of bond to establish this so-called asset liability equilibrium in their balance sheets. And a third factor could be that simply central banks, in the case of the euro area, the European Central Bank just goes into the market, buying bonds, pushing up the prices of the bonds, thereby lowering the yield on the bond towards the zero rate, or even below that. But in any case, it's a huge distortion. It's a huge distortion, and you could really say it's an unnatural development, which causes, of course, misallocation and many, many other problems in the economies.
Big part of this, Thorsten, is what we refer to as financial repression, and that is using regulatories to force behavior. And in this example, Basel III And so what we've done with the capital requirements for the banks, it says that if you're holding sovereign bonds, they're the highest value, and therefore the leverage that you can lend against them is dramatically higher than cash deposits. So if you're a bank and you want to make highly leveraged loans, you have to have those sovereign bonds, even if you're paying a heck of a premium for them right now. And then you've got a bubble going up in the bonds because there's a shortage of them as the Fed pulls them out, and in the ECB pull them out of the market. There's less available.
Yeah. For instance, in the case of, again, the euro area, the European Central Bank has imposed a negative short-term interest rate.
Precisely.
In the money market. And that means, for instance, a bank treasurer has to pay 20 basis points per annum for holding cash. And so for this bank, it makes, of course, sense to buy into the bond market until the yield is at least minus 20 basis points. And so what happens is this negative short-term interest rate basically works towards dragging the whole yield curve into negative territory.
But what could stop this is cash. People are going to say, well, rather than do that, forget the banks. They're in a regulatory issue here, what allows them, but others, insurance companies, corporations, they're going to say, I'm not going to pay the negative yield. That's not what I'm going to do. I'm going to hold the cash in our local treasury and I'll safe and I'll pay it out. So suddenly cash is an impediment to negative rates, which forces the buying of these sovereign bonds at inflated rates. Is that why we hear so much about this war on cash that's clearly evolving?
I think now it's becoming really interesting. We just talked about the natural rate of interest, and my argumentation was that it's an unnatural thing. It's a logical impossibility, and only a coercive action on the part of central banks can make market interest rates negative. And there are some economists who would argue that the new equilibrium interest rate for many economies, or the natural rate of interest for many economies, has become negative. And in order to restore economic growth and employment gains, central banks would have to basically deliver a negative short-term interest rate. And this is the argument on which the call for getting rid of cash payments is based. I would argue this is a misuse of economic understanding for pushing through an actually bad plan, namely to get rid of cash.
Yeah, well, we're being told on the war on terror, it's to find funding sources. So we need all of these controls on deposits, withdrawals, transfers, even the usage of the money. On the war on drugs, it's the same thing, the illicit use. We're being told that the black economy, underground economy, is robbing huge amounts of tax money today. We're told that the reason velocity of money is falling is because of hoarding, and we've got to stop this ugly hoarding of cash and say. We used to call it savers, and it was prudent, but that's not the right thing to do. And I can go on, but these all sound like good arguments, but it's misinformation. This is really about trying to control these interest rates in a longer term, because otherwise they're not going to be able to the government debt.
Yeah.
It seems to me that that's the essence of what's happening. I
don't buy into this line of argumentation. It's not about war against terrorism or black market activities. The debt load in the banking system and in as far as government debt is concerned is spun out of control. And if you succeed in imposing a negative interest rate on time and savings deposits, you actually can reduce banks' debt load at the expense of savers' wealth. And this policy is basically meant to redistribute wealth from the saver onto banks and governments. And in order to prevent people from withdrawing their money out of the banking system, you have to stop the use of cash. And so I think this is a misuse of an economic argument for making a case for the war against cash.
If we remove cash, we surrender controls to the banks, because right now we can withdraw money from the banks, and when we lose our ability to do that.
By the way, you're right. If you look into your contract, you would find that it is your right as a holder of a deposit to withdraw your money in form of cash.
But it's
a contractual right.
It's different when it's a credit. And we're not using cash and the restrictions. I see it when we shut down ATMs and you suddenly can't get it. I see people that are being restricted in how much they can take out. But governments were supposed to regulate banks. I'm wondering whether the banks are now regulating us. And if we go to a cashless society, we all know the premiums you pay on credit cards if you're late or if you're delinquent, if you get large balances, they're just atrocious. But what most people don't understand is the seller of the product to you use your credit card pays a 5% or thereabouts fee to the banks. If we can't use cash, those fees will be 10 or 15% pass on to us. It would be a massive bonanza for banking to go to a cashless society.
Yeah.
I mean, I can't imagine that they're going to do anything but spend huge amounts of money in the next U.S. election on campaign contributions to make sure this happens. Mm. On the war on terror, on the war on drugs, on the war
on this war on savers and
it's a war on pensioners is what this is.
Oh, yes.
It's a war on the baby boomers.
One thing is for sure, Gordon, it's not to the benefit of the man in the street.
But it's being sold that way, isn't it? It would appear. Thorsten, where do you think this goes, and how does it? Not necessarily how does it end, but what should we expect to see over the next 12 to 14 months? Because we're clearly now on this road.
One development could be that, for instance, asset markets like the stock market or the housing market will show further price increases because some people start realizing that they're getting robbed under the policy of low or negative interest rates. So they take their money from their checking accounts or time deposits and move it into stock markets or housing or real estate markets, thereby pushing up prices. So I think the risk or chances, whatever, are that we see another speculative bubble appearing in many asset markets.
Is this something we could refer to as a von Mises crack-up boom?
Yeah, the crack-up boom I think was really special. That was meant to describe the situation back in 1923 in Germany, in the former Weimar Republic, when people really started expecting a total collapse of the purchasing power of the former paper mark. And so they start fleeing from money. In this case, I think people would consider it as a portfolio shift, moving away from this low interest yielding stuff into assets that promise a higher return on invested capital. And but to some extent, it is maybe a small crack-up boom.
Well, so far. But, and we've talked about this before, hyperinflation is a currency event. It's not prices going up. It's a devaluation or the loss of faith in the currency, which the Weimar Republic clearly demonstrated with a loss of confidence in the currency.
That's the source of the hyperinflation, and the rising prices are the symptoms.
Exactly. So if we go to today, right now with negative interest rates, what's happening is it's better to own a stock that has a yield that's going up, even though it may be an overinflated stock, because you're getting not negative, you're getting positive nominal yields out of it. And the underlying collateral still is bricks and mortgage of a globally based company that has some level of pricing power. So even taking negative rates on the sovereign bonds, there are many players who are now playing an elevated, buying stocks that are just as elevated in price to try and get at that yield. But it's almost a currency play also, because they're betting on the value of the currency, and that is that the U.S. dollar is continuing to rise in value as you have this short squeeze in the emerging markets. Does that make sense to you?
Well, from an exchange rate point of view, my sense is that, and you may be surprised to hear it, that the U.S. dollar is presumably still the more or less most attractive unbacked paper currency in the world compared to many other currencies available, like the euro or the yen. And in the current situation, I think where the problems increasingly appear in the so-called periphery of this global fiat monetary architecture, there is a tendency for investors to return to the core of the system, and that is the US dollar. And we have seen in recent years an appreciation of the US dollar against basically most currencies in the world. And I think this is an indication of the problems within the global monetary architecture, in which the dollar is still, from the viewpoint of many investors, still the most attractive unbacked paper currency.
It's been my view, Thorsten, for quite some time, a few years now, that the U.S. dollar is the worst currency in terms of being backed and as and really the underlying asset of supporting its current value, probably overvalued by 40 to 60%. But having said that, I believe very strongly it'll be the last currency to collapse or to fail in a fiat currency system. Yeah. So it's not just the least ugly at the party, but there's this force. The whole carry trade is premised on the cardinal sin of a carry trade is to always borrow in a currency that's falling in value and invest in something else. Well, what's happening? We have $9 trillion that's been lent in U.S. dollars to emerging markets where their currency's falling. It's forcing the U.S. dollar up. So there's this panic into the U.S. dollar, and I happen to believe we're still early in that game.
Yeah,
as bad as negative as I am on the currency.
Yeah, you're absolutely right. I mean, it's always a relative game, you know.
Yes, exactly.
If you look at Japan, they're in deep trouble economically and financially speaking. And also in the euro area, investors still face a risk of getting the euro inflated, or there's still a risk of the whole thing falling apart. So you have a considerable credit risk. And viewing the pros and cons of each currency, the dollar still comes out as relatively attractive. And
as long as, Thorsten, in my opinion, as long as what I'll refer to as the currency cartel continues to dominate trade, and that is there's four currencies, the yen, the euro, the sterling, and the dollar, that control about north of 90% of all currency trading in the world because of the trade. So as long as they're working together and debasing in some systematic fashion, which they are, watch quantitative easing ringing around the rosy here, you have no alternative until there is a legitimate alternative. And that is appearing as every day China and the BRIC and the emerging markets come together and become a legitimate, as they do more and more trade separate from that. And if the yuan became gold back, the flight from those currencies would be astounding. But it's not in their best interest to do that yet.
Well,
possibility?
I would agree. Yeah, sure. I mean, when you look at the last decades, you know, we can observe that more and more currencies, or the competition of currencies, let me put it that way, has been increasingly reduced. Look at Europe. We had various national currencies. They got merged into one single currency, namely the euro, thereby reducing the competition of currencies in Europe. And I think this process continues on a global scale. And of course, the international banking system, central banks have a very strong incentive to cartelize under the leadership of the United States of America. And I think it's still an open question whether China really seeks a competitive monetary model, or whether China and other BRIC countries might team up with the United States of America, in which, in this case, the concentration of currencies would become even more severe. And I think this is actually, for me, a pretty likely scenario. And I'm therefore have very little confidence in the value, in the purchasing power of all these fiat currencies around the world.
Exactly, but it can go on for quite a period of time, can't it?
Yeah, sure. I mean, as an economist, you can, of course, find out with precision, so to speak, where problems are. But in terms of timing, you couldn't make any exact forecast.
Thorsten, any last messages you'd like to leave with our listeners? Because we probably won't have a chance to talk here for a while.
Yeah, sure. I mean, I think the topics we discussed are very, very important for all savers and investors. I think these are the issues that have to be factored in any portfolio decision. And my take is, if people would ask me what should I do with my financial wealth, I would recommend two asset classes. On the one hand, stocks, productive capital, good companies that have valid, solid and robust business models that can cope with inflation, and on the other hand, to put some of the funds into the ultimate means of payment, and that is gold.
Thorsten, how could our listeners learn more about your writings and your research?
Maybe they should visit my website. It's www.thorsten-polleit.com.
Appreciate the time. I need to say to our listeners, our discussions are exactly that, a discussion. They're not an interview, so we have an exchange. There's a number of tapes that are on our site of previous discussions we have, and I encourage our listeners to go back and have a look at them. And we'll have you back again, not too distant future, Thorsten.
Thanks very much for the invitation. It's a great pleasure.
Thank you very much. Bye.
Thank you. Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.